Well, the timing was off there a bit, guys. Welcome live at 5. My name is Jeb Smith. My guest, as always, is Josh Lewis. He's in a
Prison. It's a
motel
prison
room
cell.
in some place in Texas that they rent by the hour, it looks like. The lighting's awful. But welcome to the show, Josh.
Thanks for having us. The best part, Jeb, is what I have in the center console of my truck. I travel with this because most times we drive. I'm like John Madden. I don't fly. We drive everywhere. So I keep a nice HD webcam with a ring light on it in the center console of my truck. And I told myself, hey, remember to take that when you leave. But at 6 o'clock in the morning this morning when I was driving to the airport, I left it in the center console. So we get to look like we're recording from prison tonight.
Well. First, I want to say thank you guys for being here. For those of you who show up every week, appreciate the support. For those of you who are new, I appreciate you being here, checking it out. Put your questions, comments in the description, in the comment below, rather. We'll do our best to get to them. We got some big news, right? So today we started, the Fed finally came out and gave some guidance, if we're going to call that a forecast, if you will, as to what they are going to do with regards to raising the Fed funds rate. They've essentially come out and determined or whatever the word is I'm looking for here, drawing a blank, that they are going to end the tapering in March, as they said they were going to. And essentially that's going to be the first Fed funds hike as well. So a lot of people thought it might be as late as May. The earliest was March. It looks like it's going to be March now. That obviously hit the stock market, performed pretty well after that. But the bond market, mortgage-backed securities, got hammered. Josh, what does that mean? What happened? Let's talk about it for a minute.
So really, over the last week or so, bonds have
Confirmed.
improved.
Confirmed is the word I was looking for.
Confirmed.
Sorry.
Okay.
Yes.
So over the last week or so, bonds had improved and got an eighth, maybe a 0.25% back of what we had given up since the start of December. And a lot of that was just because the sell-off was overblown. The market doesn't just move perpetually in one direction. Even if the move is to higher rates, we expected a correction. We got it. Going into the Fed meeting today, it was a very flat market. Market had not improved or gotten any worse. Monday, Tuesday, market opened relatively flat this morning, and we're sitting here going, okay, what is the Fed going to say? Pretty much everyone knew what they were going to do. Like, we've been talking for about, 2 months now, 3 months now, that they've said we're going to taper our bond purchases, both treasuries and mortgage-backed securities. So everyone knew that was coming. So the unknown was, after that is done, which they told us they were going to do it in the first quarter, be done with their bond purchases in the first quarter. After that is done, they're going to hike. So the question was, okay, when does it start? And how aggressive do you expect to be? There is actually a word for what Fed chairs do at these meetings. It's called Fed speak. So they come out and they talk in circles and they're vague. So they give a plan, but it's gray and mushy. So you can't really upset markets one way or the other. Today, Fed Chair Powell came out just guns blazing, hot, basically saying we have an incredibly hot, tight employment market that's going to give us cover to raise as much as we need to. We're going to raise aggressively. So if you go back, Jeb, if you remember last week we were talking, why are we at this point? Why did rates hang so low and then shoot so high in such a short period of time from the beginning of December? Well, the Fed should have been tapering their bond purchases throughout the second half of last year, and then in a position to slowly raise here in the first part of the year. They didn't do that. So bond markets were looking at hot inflation figures, seeing the Fed still being really accommodative with negative real interest rates, buying bonds in both mortgage and treasuries, and they didn't like it. So the market started inching up, and now just really threw a fit here at the beginning of the year, saying, Fed, come do something. So now the flip side, we had hinted at this last week. What I really see after what he came out and said today, they're going to aggressively tighten here the first half of the year, and it's going to push us towards a recession sooner rather than later. I'm not saying it's coming in the second half of the year. We talked about Elon Musk saying it's going to be middle of this year. I would say towards the end of the year, early part of next year, if the Fed does what Powell said they were going to do today. There's always time for them to read the tea leaves as they roll out through the rest of the year and back off. But if they do what they say they're going to do, The issues that led to the spikes in inflation last year will largely resolve themselves at about the same time they are just putting the brakes on everything. And the economy will come to a screeching halt. And they're going to go, oh shit, we really didn't need to come in as hard and hot as we did. So we'll see. I still highly doubt they're going to be as aggressive this year as they indicated they would be today. But as of today, markets didn't like it. Rates were about an eighth of a percent worse just today, which isn't a huge move. But let's see what happens over the next few days as they digest what Powell said today.
Got it. So my oldest son is in the chat here telling me he loves me. So love you, bud. I have him watching this. He said he wants to be a realtor one day. So I put him in a corner in a box and play YouTube and make him watch this so that he learns the business and is an expert by the time he's ready to come into it. So
that's child abuse, Jeb.
No, it's not. It's you're producing, experts in the business. That's what was done to me. I had to sit here and watch. That's how I learned the business. I just watched YouTube.
Jeb, as long as
no experience.
As long as we're on the topic of Jeb, we're going to get to the best and first question of the day. John Doe wants to know if he should take out a HELOC to buy a herringbone. His trash stash is filling in thin and patchy, but he's still chainless. So he thinks if he gets a tight herringbone, no one's going to
like
notice
me in high school.
Thin stash.
And for those of you who don't know what that looks like, I might pull it up. But no, back on topic here for a moment. So what you mentioned, so I usually start talking about inventory, right? So inventory here locally where I am, Orange County actually dropped a little bit from week to week. I think we were at 1142 this time last week. We're at 1116 today. So 1,116 properties in all of Orange County. For those of you who know, say it every week, 3.3 million people. Very little inventory. Last year, this time we had 2,600 homes. So still a lot less inventory. Huntington Beach, we went up from 76 to I think 87 today. So increasing inventory, still well below where we need to be. But that's what's happening, right? Seeing inventory come on, seeing it go off pretty quickly just because of buyer demand. Now, I was at a conference yesterday, locally here in Orange County. Mentor of mine, Brian Buffini, 500,000, I don't know how many people were in the room, but all over the country, agents and asking what's happening in your market. What are you seeing? And these are top markets, Phoenix, Texas, Florida, New York, Boise, for example, Northern California, all over the place. And the majority of them, pretty much consensus of what we're seeing here, right? Not a lot of inventory. Things are still moving very quickly, difficult to get buyers in. Boise did say, the agent that I talked to there, they have a little bit more inventory. You're not getting deals on property, but instead of the 0.2 months that they had, couple months back, they now actually have over a month's supply of inventory, and you're actually able to buy properties at the list price versus having to go way over. Now, I asked the question, what do you think that means? She's like, it's hard to say, right? We were able to catch up with building and some other things over the last quarter of last year, and things are kind of, inventory is picking up a little bit. So some markets you might see inventory, but she said demand is still very hot. There's still a lot of people looking for the right property. Now, one thing Brian said is that the first half of the year, the first 6 months of the year are going to be hot. It's going to be a very competitive market above the asking price. Things are still going to move quickly. Does think the third quarter things are going to slow down a little bit. Now, I asked the question of what does that actually mean? Now, when you say slow down, does that mean you're going to see a decline in the market, or are you going to see values decline, or what does it actually mean? And basically said that he just thinks it's going to be easier for home buyers. Not that there's going to be 20 offers on a home. There might only be 3 or 2 or 3. And he thinks it's largely due to rising rates. He thinks the rates are going to stay upwards of where they've been for the better part of the year. Now, whether he's right or not, it's hard to say. Now, he's not saying that they're going to go over 4% or what have you, but he does think that the rising rates are going to impact more affordability more than anything else. And that's going to allow more people to get into homes. Now, he did say that he thinks that the market's going to probably continue appreciating 5-6% over the next, even next year. So even with that slowdown, you're still going to see some appreciation in the market. So, Josh, we've talked about rates potentially coming back down. We've talked about, what Barry Habib said, and the fact that, the Fed raising the Fed funds rate should, and, if historically speaking, it copies what's happened in the past, that rates should actually come back down a little bit. Do you want to talk about any of
Well,
that
yeah,
forecast wise?
one of the things that Barry's been on here recently is that the Fed can tighten in two ways. They can raise rates, and they don't control mortgage rates, and they don't really control any long-term rates. So what you start to see is short-term treasuries popping up, rates on credit cards, that type of stuff. So your short-term borrowing gets more expensive, but it doesn't really move interest rates. What they can do to move mortgage rates is to start unwinding their portfolio. So we're saying in the first quarter of this year, they're going to stop buying new mortgage-backed securities and treasuries. They're not going to add to their portfolio. But every month, what they do is when bonds mature, the treasury bonds that they own mature, and when the mortgage-backed securities sell or refinance and pay off, they take that and they buy. And they haven't said they're going to stop that, but what they hinted at pretty strongly today is that they do plan on stopping their reinvestment. So reducing the size of their portfolio, which is just monstrous. I don't have the number in front of me, and I would probably misspeak if I said it because it's such a large, shockingly large number. But if they started truly becoming a seller of mortgage-backed securities, they could crush interest rates. But there's something that's really important to remember. Whenever it comes to this, the little, bad news bearers, Debbie Downers in the mortgage industry say, cool. So you say the Fed or the government borrowed 4 times as much, added 4x to the national debt in the last 15, 18 years. So they have to keep treasuries down because that's how they finance that debt and keep the cost of it low. But they could always choose to let mortgages do whatever they want and only buy treasuries. There's an element of truth to that, but there's a strong wealth effect to home ownership that if you let rates go to 7%, I'm not saying that's even possible or a real number, but if you do, home prices absolutely come down because there are so few people who could afford the current prices at a 7% interest rate. Home prices will come down. When home prices come down, people don't feel as wealthy, they don't spend money, they don't take vacations, and you're basically shutting the economy down because of that negative wealth effect. So they can't do it. They really can't. The Fed, you talk about Fed overreach and where they lost their way in the last 25 years. It was never a mandate. Full employment and keeping inflation in check are the Fed's 2 mandates. Well, somewhere along the line, they also concluded that they should keep the stock market from tanking and they should keep Americans feeling good about the economy. And that you can't do all of those things. But as long as their job is to not let the stock market tank, the same things that would tank stocks would also do the same thing to housing. So what they would like to do or what they think they want to do often conflicts with reality. With so much in politics, politicians say a lot of things and they may even mean them that they would like to do them, but when it hits reality, it's not possible. And from that perspective, the Fed is hemmed in. They have to keep mortgage rates low and they have to keep interest rates low. And above and beyond that, we talk. Everyone's here freaking out and worried about inflation. There's the big macro trends over the long haul. We have an aging population. We have an over-indebted government, and not just our country, every major economy around the world. And then we have the effects of technology. All of those things are highly deflationary. Deflation leads to lower interest rates, and it changes everyone's worldview. Inflation gets a bad rap, but without inflation, you don't have compound interest working in your favor. You don't have the stock market and 401ks and all those things working. So when I say deflation is going to keep rates low, I'm not cheerleading that. It makes it harder to get ahead when you don't have inflation and growth in the economy, but it's going to be really, really hard to do that in the next 10, 15, 20 years. And that tells us interest rates are going to stay low and hard assets like real estate are going to stay really highly appreciated.
There you go. All right. So we don't have a ton of questions at the moment. Let's see here. I'm just trying to go in through these things.
So do you want to go back and wade into the debate on someone saying pineapple pizza? Your favorite hi y'all is saying pineapple pizza is underrated?
No, that's not even like I didn't even want to put that on there because the fact that anybody puts pineapple on pizza, we don't want to talk about that. My kids do that. My kids. Yeah, kids do that.
Yeah.
And guess what? I don't eat that pizza. I get my own pizza.
No, and then this broke my heart reading this, Jeb. Lego pipes in and says she has pineapple on her pizza tonight, and she's eating Domino's voluntarily.
Dude, she lives in the Midwest. They might not have lamppost pizza. They might not have Mountain Mike's.
I don't know.
Bro, you're
And
back.
by
Like
the
maybe that's the
you
only one.
you led me strongly astray. Mountain Mike's is not in the same category as
Oh,
lamppost.
bro, you're wrong. But here's the thing. Yeah, we're not even going to go down the road of pizza because we could just talk about pizza all night. But let's see. What are we talking about? So here's a side note. So to give you guys something to think about while you're watching this, other than me and Josh talking, podcast coming February 1st. We're going to talk about the housing market so you don't have to stare at our faces in a form where you can listen to it in your pocket and not have to look at us. I mean, look at Josh, for God's sakes. You don't want to stare at that while you're listening to him. So ideas. What should we call the podcast? We have some ideas, but we'd love to know what you guys think. Put them in there. I'm curious to see what Willing's going to come up with because, creative as he is, or she in that regard.
You can't have a 37-word podcast title, so he's already excluded.
All right. Let's see. Do we have any actual questions here? Just
This is really a comment. Let's start the willing portion of the night. It says, what would you say to a borrower? Says, I just deposited 50,000 at your bank. I can easily pay off this lot loan with a condescending, belittling tone to boot. So here's the funny thing. Willing jokes and sarcastic and all that fun stuff, but you would be stunned and amazed how often we hear things like this. Borrowers say, well, I've got $250,000, so you should just give me the $1 million loan to buy this property, despite the fact that I don't have a job or I have a 580 credit score. It's just important to note that it's not a matter of this one element of your loan is strong or you have this much on deposit. It really comes down to everything about the file. Because remember, 90 something percent of loans, probably 98% of loans, don't go to a portfolio lender that holds that loan and therefore can make their own rules. It's going to need to be underwritten to the guidelines of Fannie Mae, Freddie Mac, FHA, VA, USDA, and most jumbo lenders in the second that are buying in the secondary market are even stricter than that. So you may have some very, very strong elements of your file. It doesn't allow us to overlook the other weak elements. And it doesn't mean that we're not wanting to work with you or trying to look down at you. It's just, unfortunately, that's what our job is to make sure that everything about your file matches up to the investor's guidelines.
No, absolutely. We're getting some questions now, so I'm going to throw a question up here. I am going to go back and read some at the top, so if I did miss something, I'll throw it up. But my dualor, if someone isn't on a mortgage but is on the title, do they still have to report that they bought a home that year when they file for taxes? So not on the loan, just on title. The answer is no. You don't have to report that you bought a home. In fact, you can be on the mortgage and not report that you bought the home if you're not taking the mortgage deduction. Isn't that accurate, Josh?
Yeah, you're not required to take the interest deduction, even if you were the only one on there. You don't have to say, I own a home and I'm taking the interest deduction. You can. One of the big changes, Jeb, with the taxes, we used to talk about there were 4 pillars of why home ownership builds wealth. And one of those 4 pillars was the tax benefits. Now, when you look at Trump's 2018 tax cuts, for a married couple, you have a $24,000 standard deduction. If you have a $300,000 mortgage at 4% interest, that's only $12,000 of interest. You are most likely still better not itemizing unless you have large other potential itemized deductions. So there's many instances where people who own their home are not reporting interest or that they own the home, even if they're the only borrower on the loan. So no requirement that you report it. The government doesn't care whether you own your home. They care whether you're claiming deductions related to home ownership.
There you go. Let's see. Gondon 21. What do you think of the Antelope Valley market? I don't know it well enough to comment on it. Unfortunately, I wouldn't be a good source for you. I do know agents that serve that market. If you need somebody, reach out. I'm happy to connect you with somebody in that area.
Jeb,
yeah.
For Southern California, why don't we just talk in general about all of the desert communities,
Okay.
The whole Antelope Valley, Palmdale, Lancaster, the other cities of the high desert, Victorville, Yucca Valley, all those areas. much lower priced than Orange and LA counties. The further you get out, the less scarce the land is. So what happens, and I think we've talked about this on the show before, I have a heat map that was awesome that went from like mid 80s through early 2000s, showing several boom bust cycles of Southern California real estate. Those areas are the last to go up. When they do get going, they generally go up really fast because the homes out there are really affordable relative to LA and Orange County. And if and when you do get a correction, those home values come down first and the farthest, not on a dollar basis, because those homes are cheaper than things closer into Orange and LA County, but on a percentage basis, they'll generally fall a little bit more. So it's just important to know where you're at in the cycle and what you're thinking. And I would say what we're 16, 17, no, so 13, 14 years past the last downturn. They haven't had as much excessive overbuilding out there as they did the last time.
Right.
So there's less of that to worry about. I don't think they will have as big of a downturn as they did the last downturn relative to Orange and LA County, but it's something to be aware of. You have a longer commute. You have much better affordability, and you can get a newer, nicer home. You know, the people that you've referred, Jeb, out to Adrian, you look at their homes, you're like, these are really nice homes that they're buying out there. So you just go in with eyes wide open and know what you're looking at. It's a good market. You can get a good home. Just get with an expert realtor that can advise you on everything you need to know about that market.
Yeah, I mean, there's definitely pros and cons, right? The pros that you're able to buy a home that's more affordable. The downside is a lot of times you're in areas that are lessly built. Like you might be further from the grocery store, further from whatever, further from town, and just different things that may or may not suit your lifestyle. You might have a longer commute to work or whatever it is. You just have to know, going into it and consider those things, right? We've seen people over the years make rash decisions, say, you know what, I can't purchase in Orange County. I'm just going to move to Temecula. And they get out to Temecula and they're like, what in the hell? Like I am, 2 hours from work and all of these different things. I can't do this, and end up moving back. I mean, the same thing about people moving out of state. They do similar things. So just, the grass isn't always greener per se. So just make sure you're doing your research, spending some time talking to agents that know the area, to find out exactly what is there so that you can make, the right decision for you. It might be the right decision, but just understand what you're going into. And, those that are considering maybe going out there for 2 to 3 years to build equity so they can buy something back here, that's a tough one. Just because, as the market's appreciating out there, it's also appreciating here. And as Josh mentioned earlier, the market turns it all. That area out there is going to actually get hit before the areas that are coastal, if you will. So it doesn't always work like that, but talking to a pro, they can guide you through that. All right.
I was going to tell the story about my first year of junior college when we played Antelope Valley College and J.R. Ryder played there. But yeah,
did he do a dunk between his? Did he do the? No, he did the reverse. The what the hell
he
was
did
that?
His was the between the leg one. But what he was most famous for at Antelope Valley College was going through the Jack in the Box drive-through and throwing a shake at one of the cashiers there. That was his
Dude,
claim
I
to
can
fame.
Appreciate that. I've wanted to do that.
Can't blame the guy.
Yeah, I mean, he just did it. Like I've wanted to do that. I've never been into a Jack in the Box, by the way, ever.
That's not true. That's not true. You're telling me that a Jack in the Box taco has never crossed your lips?
Never.
You lie.
Never in my life.
You lie.
I swear, I've never been to a Jack in the Box. Anyhow, let's see here.
My favorite part of the show is that Jeb and I get to know each other better every week.
All right, let's see. KC Family Home. So asking prices in San Diego come back down to reality. I talked to Dan Parker last week on his channel, another YouTuber, and he's in the San Diego market, kind of specializes primarily on San Diego versus, the entire U.S. And seeing a market very similar to ours. I mean, it's appreciating quickly. Things are moving, not a lot of inventory. I think San Diego was number 1 in appreciation last year behind like Boise and Phoenix area. So did really, really well. It's going to be, remain in high demand just because of the weather and a lot of other factors that people want to move to San Diego. So coming back to reality, at this point, I don't know what reality is, because, I mean, I'm putting in offers for buyers, and we can talk about some of those that I've done recently, and striking out, right? I mean, I happened to put in an offer, 2 days ago, for someone that we've worked with in the past, and property was priced at 940 in Lakewood, actually in Long Beach, right on the border of Lakewood, and we made an offer at 971. My suggestion was high 900s, probably even into a million, just because I thought based on comps it could go there. And there were 7 offers, and we were essentially the bottom of the barrel, is what I was told. So and I've got similar stories as to 3 to 4 other offers I've written in the last 2 weeks, and some of them I've told on here, so I won't repeat them. But I mean, every offer has been above the asking price. Every offer has been, aggressive with regards to appraisals and loan contingencies and waiving certain things, and we're still coming up short on a lot of these. So still aggressive. San Diego is going to be much the same, in my opinion. I'm not in San Diego, but I can pretty much assure you that it's a market similar to where I'm located in Orange County. Anything you want to add to that, Josh?
No, it's a really strong market. And one of the things that we talked about a lot last year when everyone was here saying this is irrational, these prices are way too high. Ignore prices. The number that you want to look at is the affordability figure. And that is impacted by both interest rates and prices. So last year we had really low interest rates, record low interest rates, while prices were going up. So the prices made a lot more sense. So at some point, we are going to see interest rates come into the equation if rates continue to go up. We already led the show. We talked about the Fed. If you listen to the Fed and took what they said today as fact, they're going to shoot rates to the moon, and we're going to have 6% interest rates in the next year or two. No world in which that happens. So we really just have to let it play out. The reason why longer term we project for lower interest rates are the deflationary forces that we talked about. And as long as interest rates keep going down, and there is a portion of the population, remember, it's about 65% of American households are homeowners. And when we talk about who's having trouble, who's struggling, people that are worried about minimum wage laws, people who are not going back to their minimum wage jobs, those are not generally people owning and buying homes. So there's a lot of things that could, in the long run, impact home values everywhere. And if you look at affordability levels, we are now, because rates have pumped up and values are at all-time highs, you're seeing affordability levels come into play. But there is still plenty of willing demand that we're having bidding wars, willing and able demand at current interest rates. So rates would either have to go significantly higher, or prices go significantly higher to just take it down to a really low level of bidders that would not push prices up. It's supply and demand, and right now those forces still lean in favor of higher prices. So Jeb talked about Buffini projecting 5-6% this year, hopefully next year. I wouldn't have any problem with 3, 4, 5 years of 3 or 4% appreciation. That would be really good to kind of get the fundamentals back in line. The market just doesn't generally work like that. It overshoots it like we saw last year, and then you'll see a little bit of a correction at some point. It will happen, but I think people, most of you, just realize if we took a poll over here and said, how old is everyone watching this? On average, it's going to be about somewhere between 35 to 40. Most of those people were pretty darn young when the last downturn happened. So they think that's what a market correction looks like. It's not. It's the mother of all corrections. It was the only time that we've ever had the mortgage industry and real estate be the actual massive cause of an implosion in the economy. So you're never going to see that again. So when you're saying, when's it going to crash? Or I wanted to do that again because I can't afford $1 million in San Diego. I want to wait till they go down to 600. It is never going to happen.
All right, there you go. We're gonna talk about some affordability thing here in just a minute, but hi y'all. It comes back and says, if my baby mama is on the mortgage but not the loan, will she keep it when I die? So it's a mortgage and the loan are the same thing. Now, if you're saying she's on the mortgage but not on title, or on title but not on the mortgage, then we're talking about a different thing, right? If she's on the mortgage and not on title, she's kind of screwed. If she's not on the mortgage but on title, then she has an opportunity to take the property depending on how you have it title vested. So if that makes any sense at all. So if you want to clarify whichever way you're talking about, we'll address it further.
Being on the mortgage or the loan gives you no rights in the property. Being on the title gives you full rights in the property and does not require you to be on the mortgage. So that's in simple terms.
There you go. Josh, should I get an ARM? Buy now and maybe worry later. So affordability is becoming more of an issue, right? Rates are up, house prices are up. ARM, ARM, what's an ARM? It's an adjustable rate mortgage, right? Typically fixed for 5-7 years in this market, at which point it would adjust after that. Is that something that you're seeing people consider now? Are they more aggressively priced? What are your thoughts on adjustable rates? Because nobody's really had to consider an adjustable rate really over the last 2 to 3 years, just because rates have been so competitive on 30-year fixed. You'd be crazy to even take an adjustable, but now it's becoming something I think you might see more of.
So you want to look at it. It's risk versus rewards. You want to quantify how much am I saving by taking an adjustable rate, and then what is my risk? We don't really see a lot of immediate adjustables or even 1 year adjustables. They're all fixed for a minimum of 3, more likely 5, 7, or 10 years, and then switch to an adjustable rate. A lot of the lenders, I get things in my inbox saying, hey, we're offering Fannie Mae ARMs now. Hey, our jumbo product now offers ARMs. And you go and price it out, and the interest rate on the ARM is worse than on the fixed. And the reason for that is anything that gets sold into the secondary markets, the lender is of the belief that when you get to the end of that fixed period, that loan is going to either be refinanced or sold. Just like you, the homeowner, are thinking, hey, before it ever goes adjustable, I'm going to either refinance or sell. So the lender never really gets to that portion where they benefit from the interest rate being able to go higher, or if rates had moved lower, adjusting and going in your favor. So long way of saying, the only types of loans that I see where there's a benefit to it is portfolio loans. We have a couple of California banks here that will do unique things for our jumbo borrowers, and they strongly prefer adjustable rate loans fixed for 5, 7, 10 years, and you'll get a nice little savings on it. So, for most people, it is incredibly rare that you would be in a loan more than 5 to 7 years. And even at 5 years, when we pencil it out, those have caps. So really, it would be 7 to 8 years before it was more expensive to take the adjustable 5-year ARM versus a 30-year fixed if you're getting even 0.25% interest savings. The problem with most of the loans that borrowers are doing, Fannie Mae, Freddie Mac, FHA, VA, there's just not a huge benefit. The FHA and VA, there can be, and those ARMs are a little bit unique. I haven't looked at those recently, and I probably should. That's a good question, because they both have some interesting protections built into their ARMs, and they will actually offer shorter ARMs, even that 1-year ARM that we were talking about that adjusts every year. But most people just aren't comfortable with that level of risk. So I don't see it being a big benefit, just like right now, I don't see the 40-year loans being a big benefit to affordability on the market.
All right, there we go. So simple name. I'm trying to read the question before I put it up here, but then I just look like I'm not paying attention to anything. So what areas do you think won't be affected by this huge 34% increase of home prices, like county homes located 30 minutes plus commutes versus homes close or in town, especially like Mayberry towns? It's hard to say, right? I mean, typically if the areas aren't appreciating, I don't know. Do you want to live? I mean, do you want to buy a house there? Right. There are towns all over America, mostly middle America, that were the same price for 20 years. They never appreciated. While markets like California, markets like Florida, New York saw appreciation year over year. These are markets that the homes never appreciated. People bought them at 150,000, 200, and they were worth 150,000, 200,000 20 years later. But those homes cash flowed really well. So for investors, they made good sense because the rent was a decent amount. The mortgage payments were low, but even those places over the last 18 months have seen appreciation just because of people moving out of the bigger areas into some of these Mayberry quote unquote towns or what have you. So I don't know. I mean, yeah, I'm sure there's towns out there that haven't seen much growth appreciation over this period of time. I'm not aware of them. Even where I'm from, Kinston, North Carolina, rural North Carolina, 20,000 or so people when I was there. And this is the country, and homes there are appreciating. I mean, this is a town where you can have there's all the land in the world. You can go build something. You can do certain things that you can't do in places like Southern California. And even it's appreciating. So, Josh has brought up, towns outside of New Orleans that were affected back during, which hurricane was that?
Katrina, brother, the
Katrina, yes,
mother of all
Katrina. I forgot the name.
hurricanes.
Hey, bro, come on. Got too many things going on here. That outside of that area that haven't appreciated. In fact, that they've stayed the same or even gone down in some regards. So, typically you're only seeing that if you're seeing growth areas like where net migration is higher than people moving in. More people are moving out than moving in. Jobs are moving away, that sort of thing. And do you really want to live in a place that's deteriorating like that? I mean, that's the question you have to ask yourself.
Yeah, that's really the flip side, Jeb. Because what do we say? Why are most of these areas that are appreciating? Why do they appreciate? And why do the areas that are appreciating the most? Silicon Valley, San Diego. They've got good climates. They've got good economies. So people have good jobs and they want to live there. So if you get to an area doesn't have a great climate, doesn't have a lot of industry, so you don't have jobs where there's that net migration in, it's hard. It's hard to see as much appreciation. And you hinted at something. When I did that presentation in 2003, 2004, another really interesting thing we talked about at that time, nationwide, there were only about 3 or 4 cyclical real estate markets. In the late 70s and early 80s, when we started seeing the rise of dual income families, mom didn't stay home, mom goes into the workforce. In Southern California, that additional household income pushed prices through the roof. And then we had a little correction in the early 80s. We had another spike, and then a correction in the late 80s, another spike, correction in the early 90s. But that was really almost a uniquely California phenomenon, minus a couple of other markets. I almost feel like, again, I'm going to show my age here, but like when I was a kid,
Bro, everybody looks at you and knows your age. You're not fucking
bro,
surprising anybody.
so when I was a kid, like you would go, when I would go visit my grandpa in Florida or go visit family in Michigan, like the style was very different. The music was very different. Now you've got MTV, not just MTV, you've got internet, you've got all of those things that have changed, that kids are listening to the same stuff pretty much everywhere. And that trickles up. So when you get to be 30, 35, like that same attitude, the whole HGTV thing that got really big in the last 15 years or so. People are really keenly aware of real estate and interested in real estate, where I think a lot of the country wasn't as much. So you combine those two things, the awareness that everyone has of the wealth building power of real estate, the self actualization portion of making my house the way I want it to be, with my man cave or my outdoor kitchen or my bitchin' pool or my basement or my baking kitchen, whatever it may be. People are really drawn to homes and building wealth through them. So if an area has strong inward migration and a good economy, people like their houses, and that is almost a nationwide phenomenon. We see every week in the comments people say everywhere is like California now, and that's really true. It's really true.
Yeah, and Cole's asking a similar question: do houses in small towns follow the same trends of the general housing market? So I think we just kind of addressed that. I mean, not always, but depends, right? I mean, it depends on what's going on around that small town, right? With regard to employment, with regards to growth, with regards to migration in, how many homes they have, what's inventory, supply look like. All of that stuff matters in those markets. So not always, but this last year we did see a lot of it. Sci TV, VA loan related. Can the veteran transfer home ownership to his or her non-veteran child, like an assumable mortgage, I assume? In transferring, also refinance the home from VA to non-VA under child's ownership. Josh.
So here's the thing. All loans in this day and age have a due on sale clause. So a sale doesn't just mean you put a sign in your yard and sell it to someone else. Transferring it to your child is a sale. You transferred ownership of the property's been sold, the loan is due. You didn't break a law. There's no due on sale jail that you're going to go to jail, but the lender has the right to call that loan due. So if your child stops making the payments and they start sniffing, the lender starts sniffing around and realizes, hey, the veteran's no longer on this, they're just going to call it due. They don't have to follow the normal foreclosure procedures. They're going to be able to call it due under default under the loan, which actually does look a lot like normal foreclosure procedures. They just don't have to wait till you're as far behind on the mortgage. So now the second question is how you resolve this. Can you also refinance the home from a VA to a non-VA loan under the child's ownership? Absolutely. And that's what the lender would prefer, is that cool, transfer title to them, also have them refinance out of your name, which will restore your VA benefit and allow you to move forward and use it on another property.
Got it. So I thought VA loans for some reason were assumable mortgages
They are.
They are. So what does that mean with regards to transferring from one to the next?
You have to qualify, and you know what? They are assumable, and it's never in my life ever come close to happening. Not even a person pursuing, asking the question, "Hey, can you help me
Now
assume this VA
are they
loan?"
assumable by a non-vet, like a non-veteran?
That's the $1 million question. That's what I was just going to ask.
Okay.
I would think not, but because it has never come up for me either on an FHA or a VA. And think about that. What do we hammer on every week here? 40-year bull market and interest rates. When are assumable loans attractive? When rates are going higher. So someone has a 4% fixed rate and rates are now 6%. Hey, I want to assume your loan. And it just, you have 40 years of decreasing interest rates. No one wants to assume a loan. They'll go get a new one of theirs at better terms.
No, good stuff. Wyatt, I do not have any insight on El Dorado County market. I don't even know
Expensive.
I mean, I don't even know what cities are all included in El Dorado County, to be completely transparent here. But I know people that work those markets. So if you need somebody, reach out and I'll refer you. You kind of look like a real estate agent with that thumbnail. So maybe you're quizzing me. Is this a trick? Is this a trick you're trying to tell me? No. But if you do need insight, let me know. Let's see. Hot dog 313. Any updates on the Oahu mainly market? We spoke months ago about wondering if anything has changed, military and using VA if we decide to buy versus rent. No, I don't think much has changed. I don't know for sure. It's still, a lot of Hawaii is a lot like it was months ago. I mean, the only difference is they've kind of opened up versus where they were. And kind of gone back into quarantine in some regards and then kind of opened back up again. But I think supply there is scarce. For one, I think the market's still moving pretty good. Again, I don't know much outside of that, but again, if you need an agent, somebody there to talk to, I can refer you to somebody. Josh, any insight on that one? Hawaii?
No, Hawaii is unique just because the things that we talked about, there are only, there's a finite amount of people who want to live in Hawaii. As awesome as Hawaii is to visit, there's a finite amount of industry there. So in terms of in-migration, and then they also, a lot of it's protected and can't be built on. So you have, the islands themselves are small, and then you can only build on portions of them. Super unique. If I were wanting to buy or sell in Hawaii, I would want an expert on my side just because it's so unique relative to the other 49 states.
No, absolutely. Kind of looks like he's in Horseshoe Bend or somewhere there in the Grand Canyon. Was just there, so pretty cool. Let's check it out. We got a super chat from Dom's Vibranium Bicep. Hey, y'all. Always appreciate the information. Why are VA loans frowned upon in this market currently? So I can actually talk to this, right? I just submitted a VA loan, 100% financing for a client over the weekend. And I don't know that the loan was frowned upon. I know they had multiple offers on this particular property and ended up selling above the asking price. I didn't get much information outside of that. But what happens is, as a person buying a home, and putting no money down in most cases, right? VA allows 0% financing. You might be against multiple offers, and those multiple offers, you might have somebody that's putting 20% down. You might have somebody that's putting 10, 25, I don't know, just different amounts down. And so on paper, if you're just looking at down payment, it typically looks like the person that's putting money down, 20% in this case, or whatever it is, versus the person putting zero money down is a more qualified buyer, which may not be the case. And it's important to have your lender convey that, the realtor convey that, hey, listen, in my case, the client had, a couple $100,000 in the bank. He could have put it down, but he was choosing to use his benefits. 23-year vet, deserves to use his benefits, great rates. Why not? And so that's one thing, right? So you're putting less money down. Perception looks like it's not as good of a buyer or a loan. The second thing is, in this market, a lot of people are waiving appraisal contingencies. And you can waive an appraisal contingency with a conventional loan. And while appraisal will still be completed during that time period, you have basically told the seller that you moving forward with closing on that property is not contingent on that appraisal coming in at value. So if it comes in less, you're willing to pay some money in order to make that up. With VA, even though you waive the appraisal contingency, if you put that in writing, the FHA VA amendatory clause basically says it's almost an overlay on top of what you've stated there that says, if this property does not appraise, the borrower does not have to move forward. And in our new residential purchase agreement here in California, it states that clearly. So, a seller might say, hey, listen, this person's putting no money down versus this person's putting money down and they're waiving the appraisal. That is a better scenario for me, even though they may want to help the veteran out and get a property. On paper, it's more beneficial to them because of that. So that's the main reasons. But it helps to have an agent that understands them, an agent that wants to help veterans, an agent that, can relate to the seller, that, VA guidelines are more flexible in some ways. And, it may be a better opportunity to go with that versus the other one because of the lenient guidelines or what have you. So it's not fair per se, but it's just what the market is at the moment.
Jeb, you covered all the important parts except for the one that there's a lot of misunderstanding on agents' parts of a VA loan. Yep. That they think, well, the seller has to do this, the seller has to pay this, you got to do Good this. And the VA program, those things used to be true. So it's not wives' tales. It's just historical fact versus current fact. The VA program is very similar to any other loan type, other than what Jeb said, where they cannot waive their appraisal contingency. They can do it. They can say they did it, but there's a written clause that basically says that they can't be compelled to complete a transaction if the property doesn't appraise for what they've agreed to pay.
All right, good stuff. I don't know. What are we, 50 minutes here, 295 people watching. We have 69 likes. My goal, I have a goal tonight, right? 200 likes. Help me out. If you find the content valuable at all, hit that. And let's get there and put your questions if you have them.
You need to make it 201. You got a free one from your son.
I don't even know if he liked it. He just just came in and told me hello. He might not.
My dad's boring. I'm out.
Yeah, at the moment there's no dislikes, so, or maybe there is. I don't know. I can't see the count anymore. Let's see. What do we got here?
I got one if you don't mind here,
All right,
Jeb.
let's do it.
So a very plain and basic username. Patrick says, in your general opinion, will we see interest rates hit lower mid-4s this year? I predict 5% by November, December 22. Hopefully I'm wrong. Here's the thing. The last time we were anywhere near that was late part of 2018. The 10-year Treasury hit 3.2. We got to about 4.75, 4.85 on the 30-year fixed. And at that time, everyone in the world who had a brain knew that was just utterly absurd and that we were getting ready to see a monster rally in the bond market. And that's absolutely what happened. So could 5% happen? It could. If it does, that will end up being the high water mark, and you'll see another huge rally back down to the 3% range in interest rates. And the reason for that, the Fed, again, came out and talked a great game today. Fed doesn't directly impact long-term interest rates. There's nothing, in my opinion, that the Fed can do right now to help with what's causing inflation. We talk about this every week. The big causes of inflation was the government gave away tons of money in 2020 and 2021 to households that didn't need it. Instead of targeted aid to those that did, they gave money away for 2020. The economy was basically shut down, so you're getting these free checks and nowhere to spend it other than Amazon. And then the market opens up in 2021, and you have massive supply chain issues with all of these dollars chasing a limited amount of goods. The Fed raising rates isn't going to change that one bit. What's going to change it, and what we've already seen, is the monstrous household savings amounts and rates have already dwindled. Most households have already spent that money. Supply chains are easing and will improve. Whether they improve this year into next year, inflation will take care of itself in the next year or two, and the larger macro deflationary forces will come back into play. It's just, there's not a question about that. So could it hit 5%? Could you be right? Yes, but only in the sense that that would be just a massive overblown reaction between the Fed and markets, and it would be sort of the blow off high water mark before a monstrous improvement in rates. So the more important question there is, could rates hit low or mid four? We're not very far from it right now. So, Jeb and I, what were we saying in December? We thought the high water mark for this year would be about 3.5 to 3.75, and we're pretty much already there. We're over 3.5, almost to 3.75 today. So, Jeb and I don't have a crystal ball, but it's already exceeded what I think is warranted. So, could it exceed it more? Absolutely. Could we see a 4 or 4.25 on a 30-year fixed? Yes, if it does, all that's doing is setting up for a big refi market for all those people who came in late, took high interest rates, that it would have a major negative impact on the economy and push us to recession, lower growth, lower inflation, lower interest rates.
There you go. I realized we skipped some questions because people came in and did super chats and what have you. I'm working my way back up there a little bit to get some of those questions answered. So hang tight for me. Did want to thank Maddie for the $5 super chat. I appreciate it. I don't want to throw it up here on the screen. Well, I guess I will, just to say thank you. But I lost my spot again where I was going. But Carol has a good question here, Josh. What entities, and what actually affects mortgage rates? How's that? And what factors influence those fluctuations? So is it the 10-year bond? Is it mortgage-backed securities? Is it the Fed? Is it the stock market? Like, what pushes rates up and down every single day?
So if you want to look at mortgage rates, they're going to very closely track the 10-year Treasury. If you want to look at it, it's sort of like when you have your dog on a leash. You don't get to control where your dog goes, but it doesn't get too far from you. That's mortgage-backed securities relative to treasuries. The treasury market is better for us to look at and analyze from a technical perspective because it dwarfs the size of mortgage-backed securities. So we're looking at both, but paying more attention to the 10-year treasury. So the bigger question is, what impacts treasury rates? And now we're saying the 10-year most closely correlates to mortgages, but if we're talking interest rates, there's not just one interest rate. Short-term rates, 3-year, 6-year bills, a 2-year note. Those are things that the Fed controls very directly. And as they're raising rates, those yields will increase. If the market looks and says, no, we think inflation is under control and it's not likely to be a problem over the 10-year horizon of a 10-year treasury, yields won't increase much. So we've gone up since December. I think we were in a low in November or December of 136 on the 10-year, and we're like 186. So that's up about 35%. It's a big move. It's a really big move. But in the end of the day, it's 50 basis points. It's not that big of a move. And just as recently as last week, we were at 170. So it was only 35 basis points up. So a long way of saying the markets are shaking this off, going, yeah, I see the inflation, but what I just said, those things are transitory. The Fed saying last year, we're going to keep stimulating and buying mortgage-backed securities and treasuries because inflation was transitory, was the thing they were saying was correct. Transitory means not permanent. It just means it can last longer than they think. Instead of 6 months, is it 1 year? Is it 2 years? Is it 3 years? It's not permanent. It's going to normalize and the deflationary forces will take effect again. But what happened is they were continuing to stimulate when we're seeing inflation. So it's sort of like a fire started, and the fire department, instead of coming in and throwing water on it, is throwing gas on it. Just stupid. That's what our Fed was doing last year, and now they're late to the game. So there's not a lot to look at other than interest rates are a reflection of markets want a real return. So what is inflation? What is the return we want on our money? And what is the risk premium? So treasuries are the safest investment in the world. Mortgage-backed securities, slightly less safe, but they have an implied guarantee from the US government, just like treasuries do. So you're really just looking at what is the inflation expectation, what is required above and beyond that. And right now, markets are unclear on what to expect for inflation in the next 1, 2, 3 years. When you look at the 10-year treasury versus 2-year treasuries, it's telling you that they're not super worried about it right now, but it definitely has their attention and they're watching it. So hopefully that was helpful. I know it's kind of high level and bouncing around.
All right, good stuff. RR makes a comment. Phoenix has been out of control. The California folks are running away from California, have increased prices here. So there is truth to that, no question. I was actually talking to a friend of mine who serves that market yesterday, in fact, and we were talking about what's happening there with regards to inventory. I get his twice a month report, his bi-monthly report on the market there, and we were talking, and he said that iBuyers, like the hedge funds, have these multiple. He said they're still purchasing in the Phoenix area market. Somewhere around 20% of the homes are still being purchased by investment companies, if you will. So as much as California is to blame, you can also blame the fact that people are moving there, whether they're buying or renting. And these big hedge fund companies are coming in and buying up property. He said, what's funny is that you can tell because they're set up as LLCs, and then they'll have a name like, Jeb LLC 1. And he goes, once it reaches a certain amount, then basically what happens is Jeb LLC 2 starts purchasing. And then you start to see that name around. And then eventually you might see LLC 3 buy. But he says that still a lot of buying by big funds in that market. So I just wanted to throw that out there because I felt like it was good information based on conversation I had yesterday. ATX flips. Jeb, I am in the Austin Metro, took a 30% above the asking offer pre-MLS. Would you say that is in line with what you're seeing in SoCal? No, that's way higher than anything I'm seeing in SoCal personally. I'm assuming that means you're a seller and you accepted a market 30% above your asking price prior to you taking it to the MLS is what I get. And or you're an agent and that's what you negotiated or what have you. But no, I just accepted one here. In fact, 2 that were not on the market yet. Sellers considered both offers. One was priced at 2.7 million. It sold for 2.8 without going to the market. So that was $100,000 more. So that's what, 3% or so, 4% maybe on that purchase price. And then you've got one that I just sold off market, and it actually sold for the asking price prior to taking to the market. Now that one's a little bit different situation because they have kids, they have pets. There's some family marital issues going on there. They didn't want people really coming into the home. There's some, so there was a lot going on, but both of those, were sold basically prior to going on the market actively. And no, nowhere near 30%. 30% is absolutely insane. You seeing anything? I'm kind of still scrolling up here, Josh.
Just what do you think about this? I actually like this question.
Yep.
Stephen Yates, a regular reviewer here, says, do you think we'll see more houses during the spring or more towards the end of the year when interest rates go up? We talked about this a little last week, Jeb. Just talk about interest rates going up actually disincentivizes people to sell if they're planning on buying again. But the prices are getting aggressive. People with a plan or an exit plan, I'd love to think there will be some supply coming to market, but you were just at the Buffini event. What are you hearing?
Well, there's some belief that that you'll see some more houses in the spring. in addition to what would normally come up because of forbearance ending. Now, forbearance hasn't really been a topic we've talked about for some period of time, but because most of these people gained equity, and I'm not talking foreclosures, I'm talking properties coming to the market. And the reason for that is because you're going to have people that, their forbearance ends, and it's going to end. I think the final call here is in the next month or so, where they're done with forbearance and they've just realized they can't afford that payment. That new payment that they're making with their bank or whatever's been figured out with whatever they've agreed upon with their bank, they can't make that payment for one reason or another. So therefore, they're a seller, right? Instead of foreclosing, they got plenty of equity. You know what? I'm going to take my chips and go. You're going to see some of that, is the belief. So that's going to add to your spring inventory. Now, I don't, typically speaking, the fall market is one where things slow down. You see, not as many homes come to the market. People are in the holiday mood. All of that going on. It's hard to say, right? The last 2 years have been anomalies in the sense that hasn't happened. And I think if you do truly see rates go up and stay up, I think it's, again, like you said, disincentivize people to want to sell their properties because, who wants to go up in payment even if they're purchasing a less price home? I mean, yeah, I get it. It makes sense in some regards because you could always refinance later, but most people looking at the payment wise aren't able to figure that piece out, at least in my opinion. So it's a tough question, Stephen. I don't know the answer. I do think you're going to see more and more inventory over the next couple of weeks, but I haven't seen a slowdown at all in the last 3 weeks since rates have been rising. Right now, if they continue to do that, I think it'll be in effect. But if they don't really move much from here, and if you're moving an eighth here and there, not really a big deal. You're going to have to see some big moves, I think above 4% and stay there to really impact housing at the moment. I think people are kind of in a panic situation to say, I think rates are going higher, and whether or not they're accurate, it's pushing them to want to buy something prior to doing that. So that is driving a lot of the demand at the moment. Even though rates have risen, it's the fear, again, of missing out on being able to buy a home with a lower interest rate, quote unquote.
I look at it, Jeb, and I'm like the perfect candidate for this. I've been in my home this year. We bought it in 2003. Sure, will be 18 years. If you had told me that I was going to live in the home for 18 years as a child, my family never lived in the home for 18 years. My dad finally bought a home when I was in junior high and lived there for the rest of his life. But as I was a kid, the thought of being in a home for 18 years. And when we bought this house, I said, this will be a great place, build some equity, kind of get where we're going. We'll spit out some kids, and then we're going to build a bigger house. We never had the kids. We never got a bigger house. And now those of you outside of California probably get tired of hearing us talk about Prop 13, but even put aside Prop 13, if my taxes were at market taxes like in the other 49 states right now, if rates went up, I have a 2.75 rate on my mortgage. If I had to go and pay 3.75 and take on more mortgage to move up, so I'm borrowing another, if I want to move up, for me to move up for it to make sense, what would you say, Jeb, $400,000-$500,000 in price? And I'm going to take on 0.75% in interest rate.
At least. I mean, that's the thing is it used to be my move was to, $1 million, $3 million, $4 million, right? My next move in order to kind of get what I needed. That 1314 house now is over $2 million. So my next move is a $2 million house. My property taxes are a fourth of what the property taxes would be on that.
And
that's hard
take
to
that
justify.
take that out of play. Say you're in Texas and you have market taxes on your.
I don't want to say I'm in Texas,
but say you go from $1.2 million to $2 million. You're
the
taking
bugs. They're everywhere. God, it's hot here.
You're taking
so
on
humid.
800,000. Hey, I'm in San Antonio. It's nice. It was 58 degrees today. But if you were in Texas, you're taking on $800,000 of assessable value, and you're taking on $800,000 more mortgage unless you have that money to put down. And if you now factor that, saying, hey, rates are 0.75% higher than what you have on, and that's the best case. Someone just asked, well, could we go to the low fours? We could. So if I'm at 2.75 and the rate's now 4.25, that's 1.5%, and I'm taking on an extra $500,000 worth of mortgage. There's a lot of things I can do with that kind of money. and I'm just going to post up at my house. So we have some really strong structural incentives for owners to stay where they're at right now. So I know it's kind of a Debbie Downer answer you guys were looking for. No, there's lots of supply coming to the market. It's going to get better. But those are the reasons why sellers are not selling.
There you go. Grits and Wavy. Can I cash out refinance if I have older charged off debt? Josh.
Maybe. Do you want more detail than that?
I mean, if you want to provide it, or do you want to have them reach out or give you more
So
info? This was
no,
earlier, so they might not even be here at this point.
absolutely. Reach out, and if you're in another state, we'll connect you with someone that can actually help you. It doesn't prevent you from doing it. In certain instances, you may need to pay it off. It's unlikely. The difference between a collection and a charge off is that the lender has said, we are no longer trying to collect this debt, and they're going to take that as a write off on their taxes for that year. So, for the most part, it's no longer a risk to the lender that's making you the mortgage, because they said, we're not coming back and trying to collect this. They will look at it as an indication that, hey, you have not paid creditors in the past as you had agreed to pay them. So it's rarely a problem that prevents us from doing the loan, but if you had significant and large charge-offs, it could. So again, circle back to the maybe. Most times, yes, but the answer is maybe. Circle back, let us know, send an email, and we'll connect.
She's actually still here, so she did comment and say she was here. So hopefully
Okay.
that was helpful. But if you want to get a little more info in there, you can. Dom is asking top 5 boom towns that aren't already on a bunch of articles. So clearly think we're way smarter than we are.
Than Money Magazine.
Yeah, it's hard, right? I mean, a lot of times the towns in those are there because they have big companies moving there. They have positive net migration. More people are moving to those areas. Infrastructure is happening in those areas. That's the reason they're there. Unfortunately, I don't have that type of information, research, nor the time to figure it out. But that's what you have to look for. You have to look for areas that are growing. Those are where you want to be investing, right? Because that's where things are going to happen. Areas that are being regentrified, if you will. Like take Inglewood, for example, here in California. Inglewood for a long time.
I wish I bought half of Inglewood 10 years ago.
Yeah, Inglewood for 5 years ago, prior to them starting the SoFi Stadium, wasn't a very desirable location for the most part, right? Then you come in and they say, hey, we're going to build this stadium that's going to serve for the Chargers and the Rams. And we're going to do this infrastructure deal with regards to getting roads and freeways and whatever to figure this whole thing out. Guess what happens in the values around that area? They go crazy. In addition, you got short-term rentals going crazy. So that's the stuff you have to look for. It's not just, trying to figure out the next boom town. It's figuring out what's going to have growth. And unfortunately I haven't spent the time to do it. But there are some areas that I'm looking at personally that to try to invest in some rental property. So we'll have a conversation about that if it happens.
Don't tell them, Jeb. Don't tell them.
I don't want to have to fight. I don't want to have to fight for property until it's in hand.
But Jeb, let me throw this one up here and then follow up with a story. This is similar subject. So have the prices for 2 to 4 multi-units increased to the same ratio as single families in LA? You had talked about Inglewood. I have a client who bought in Hawthorne, right next to Inglewood, and all those areas, Hawthorne, Inglewood, have just gone nuts. And absolutely the 2 to 4 stuff. So he bought a duplex, made a really smart decision. FHA purchase with a duplex. They owner occupy. They still live there. They paid $460. We just got it appraised for $925 in the fall. So absolutely.
How long ago was that?
They bought in 2016. So less than 5 years, late 21. So probably a little more than 5 years. 5 years and a couple months. The thing doubled. And that's pretty common. But also talking about boom towns, that is a specific area where a large industry, entertainment, and the Rams and everything built around that, and then the new Clippers arena, which is way more important than SoFi Stadium and the Rams, is going to go in there, and they'll probably double again because just having Kawhi and the Clippers in the area.
Interesting. Yeah, but I don't know if it's been the exact same rate that it's increased, but it's probably comparable, and maybe even more in some cases, just because of where rents are going. It makes the the cash flow even better. Therefore, the value. I mean, most properties that are 2 to 4 units are not. I mean, they're based on the value, but it's also a cap rate, right? And so if they can get a higher cap rate, and still the value increases, it's a win-win all the way around, for everyone. If they can get a good cap rate and they're paying more for it, it's a win for the seller, a win for the buyer. How's that? That's what I meant. Let's see. I had a question here. So Terrence says, first time home buyer, is it advised to only offer on listings that would be long term, or get in and start building equity on a property that's imperfect but keeps us from being priced out? So this is a really good question and a difficult one, quite frankly, because you just don't know what's going to happen over the next couple of years. Now, I would tell you not to buy a property if you didn't think you were going to be in it for at least the next 5 years, right? And I realize that's a long time, and not because I think the market's going to tank in 5 years. I just think it gives you some security to, if the market does move at all, you've got a little bit longer time horizon. Like, for example, if you knew you were moving in 3 years, probably not the best opportunity to market to purchase in. But who's to say the market's not going to continue appreciating and you have equity? So it's a double-edged sword, and not really one to easily answer at the moment. But I think going in, when you say imperfect, buying an imperfect property is okay, but just don't sacrifice on the things that are important to you, right? I mean, don't go buy a studio if you need a 2 bedroom, right? Just to get into a property. Don't go buy a home that backs to the freeway if you hate noise and and that sort of thing, right? The homes that are imperfect, like really imperfect in the sense that they have issues with regards to location and size constraints and that sort of thing, in this market are selling at a premium, when, if there were any supply of inventory at all to balance out the market, those homes would not be selling at the values that they are. A lot of these homes that back to streets, that back to freeways, that are on the lower square foot side, typically would be selling for less than homes in superior locations, if you will. Inferior locations typically sell for less. In this market, not so much. It's crazy. Even the homes that are in inferior locations are still getting premiums on them. So just don't sacrifice on the things that are important. And I would tell you, a lot of times you end up being in a home a little bit longer than you think you will be, right? So if you're thinking 3 to 5
Like
years,
18 years, Jeff?
you'll probably be in there longer, right? Josh just said 18 years. I mean, I've been in my house now for almost 10, and that was never the plan either, but it's worked. There's a lot of pluses of the reasons we've stayed there. So you just never know, but just think it out, right? Have money in the bank, be comfortable with the payment, not stretching yourself, longer term time horizon, and you'll probably be okay. But the market is still moving faster than most people can save money. And I don't know, even with higher rates, if that's going to slow that down. I still think you're going to see appreciation based on everything I listen to and read. Even with rates going up and demand dropping a little bit, the supply isn't going to increase enough to slow the market enough to where values aren't moving steadily up by 3-5%, like we mentioned earlier.
Couple of thoughts to add, Jeb.
Yep.
So imperfect. He says imperfect, and it's a good choice of words. I love imperfect properties, buying imperfect properties. If I can fix the imperfection. Jeb listed a long list of imperfections that can't be fixed: backing to a freeway, siding to a train track, living across the street from a strip club. Things of this cannot be fixed.
Why is that a negative?
Well, it just depends on you and your family situation. If you're a single man, it might be fantastic. Um, just look at whether it can be fixed or not. If you can add on and fix the lack of a map, or the square footage doesn't match your needs, things that can be fixed are awesome. Those, and I had another thought, but those are really the big ones. Just, is it imperfect that can be fixed, or imperfect that is permanent? I had our place in Orange. I had a little open house and had a few people through to rent it this last weekend, and the family came through. They would have been perfect to rent to, and I talked them out of renting and into buying. And they had just said they had come from looking at a condo to buy, and the things they explained about it that were imperfect could not be fixed. And I said, do not buy something like that. Make sacrifices. It doesn't have to be perfect, but there are things that are non-negotiable. For them, it didn't have a garage. It had one single carport. There are two people, obviously husband and wife. And if you don't get a parking spot, you're parking across the street. And it wasn't the greatest neighborhood. Like, that's just not workable. That's not worth. You're better off renting and investing as much money as you can of your savings. So that was what I was thinking of.
No, good stuff. And sorry I completely forgot. I've been scrolling the bottom of the screen with that link. If you need to connect with a lender, with a real estate agent anywhere in the country, click that link or go to that website. It will refer you to an expert, somebody that I know personally that can guide you through the process and hold your hand. And now that is off, that I've said that, I will remove that. I meant to do it earlier and I completely forgot. But Joseph had a question earlier. Do you anticipate home prices dropping by summer in the greater Portland area where you're looking to buy more rural, but I assume homes in the sticks will follow the trend for the city? Thanks. So again, was at a conference yesterday, talked to a good buddy who's in the Portland market. Market's still moving like crazy, he said. And so he serves the greater Portland area, if that's even considered a thing, just, outside of Portland as well. And the homes in the sticks, so to speak, I don't know that they'll follow the trends per se of the city, but you're going to have people that continue to want to be out of the more densely populated areas because they no longer have to be in those areas for one reason or another. They don't have to be there for jobs. They can work from home. They don't have to, commute every day into an office, and therefore they don't have to necessarily be close to the city or whatever the reason is. So, and then you got people like, that want to get out of different states and just live a more simple life for whatever reason. So I think areas like that will continue to prosper. I just don't know that they're going to prosper at the rates of the more densely populated areas, just because it's further out, right? And that's not necessarily how, a lot of people want to live, but it's hard to say. I don't know Portland that well, but if you need a contact, there's a link in the description. I just put it up on the screen. Go there, and I'm happy to refer you to my buddy. Also a great agent, by the way. Let's see. So kind of getting down here on some.
Let's cut to the important stuff. Willing has named the podcast. He's got several options for you.
I was actually going to put a.
I didn't see 1 through 6, but he's got number 7 is cut the horse crap mortgage and real estate. Number 8 is my tango, my me grango show. Number 9, loans for days with Wolf. 10, Wolf Whisper and Lewis. 11, poolside mortgage with Wolf and Lewis. 12, maybe my favorite, feel it, touch it, be one with the mortgage and real estate.
So for those of you who don't know, podcast coming really soon, and going to be short form content, probably 15 to 20 minute episodes. We're going to talk about mortgage rates. We're going to talk about home buying, things that we talk about on video, but simplified a little bit. And you don't have to stare at us. You can listen to us. We can motivate you while you do chores around the house, you work out, whatever it is. We're going to be there for you. So you'll be able to check it out. But we ask some names for the podcast, and that's all we have so far, people. We're really going downhill quick. I'm not sure anybody's going to watch it, but I was going to put a survey out here. I have some names that I was going to post, and quite frankly, I forgot how to do the survey.
Jeb, I think we have another option. Seer Guru says we just call it Jeb Babe.
Jeb Babe. I'm not sure that anybody wants to hear that either.
With exclamation points, black hearts, and fire emojis.
Ooh, we're getting really I got a poll. I got a poll coming. Is better. All right, so actually that's just a yes or no. Can I change these? Oh, I can change them. So Josh, find a question and talk. I'm going to put some podcast options up here.
Everything's comments here that I'm seeing. We'll find one here. So this is funny. This is, again, just a comment, but Krasmir Petrov, hi, Jeb. Thanks for always replying to my comments. Market is still on fire in Charlotte, North Carolina, aiming for 4.5% rates. So it's funny. There are folks that are rooting for higher interest rates just to put the brakes on the market. Those folks generally tend to not be in Southern California, where prices are so absurd that 4.5% would be a hardship. But it's an interesting thought, and I wouldn't complain about it. But let's look at this one here. Simple name back with, what are home interest rates right now for a cash out refinance? Good credit, 15-year job, only owe 41,000 on home, house appraised for 172, and have to split equity with ex-spouse. Good news is that wouldn't be cash out. You wouldn't have to pay the cash out hit as long as we have a court order to split the equity with a spouse. So reach out to us, reach out to Jeb. If you're in California, you can reach out to me, reach out to Jeb. You can get you referred to someone. There are some unique issues with divorce mortgages that you need to structure them correctly, and it's important that you work with an expert on that so that they're not doing it as a cash out loan when it doesn't necessarily have to be.
All right, keep going.
I'm trying.
All right, I just put a survey out. Help us out with that, people. Oh, we got a super chat in here. Let's see. Did you just read that?
I did not. That's
All
a big
right.
one.
Terrence.
That's a rack of 805 you owe now.
Ooh, look at that. Terrence came in with a strong $20 super chat. Thank you, sir. Appreciate it. Great advice. Thanks. Late podcast name suggestion. No contingencies. I like it.
No contingencies with Jeb and Josh.
There's something about it. I like it. I like
Got a ring to it. What happens though when the market is slow and buyers are putting on like 900 contingencies? I'll buy if you recarpet it in red velvet. Like things need to be full contingencies with Jeb and Josh.
Yeah, we go. Then we go full Gringo me tango.
Full Gringo me tango. I got
yeah, we change it at that point. And oh boy, Moppy Toppy, Jeb looks a mess. Jesus, what happened? You know, the beard? Is it the beard? Is it the bags under my eyes? Is it the fact that I'm about to turn 42 in about 2 months?
So, Jeb, I don't know what you were looking for, but Krasimir Petrov came back with the one that we could go on for a while. Cost push versus demand pull inflation. So what are the differences? So we've talked about this. What we had last year is both. You have a limited amount of supply. So if a seller can only produce 10 widgets instead of 100 widgets, they're going to want to charge more for them. That's cost push. If their inputs, fertilizer relies on natural gas. Natural gas costs go up. That's cost push. Demand pull is what happened when the government gave away lots of money to people who didn't necessarily need it. So we've had a little bit of both, and both of them are likely to go away in the not so distant future. So big difference between the two. They're both present, and I think they'll both be gone within the next 1 to 3 years.
All right. And those of you who probably figured this out, but the last one I mistyped buyer, but it's supposed to be the educated home buyer, just so you know. But that's leading at the moment with 45%. 33 votes, people. There's 271 of you. Hit that. Give us something here.
Where did the other 35 go? We had 305. Did we chase them away?
We did. I think the me tango, me grango.
No, I think it was Seer Guru calling you Jeb Babe ran them all off. They're like, if Jeb and Seer Guru are going to get a room, we're gonna head out.
Let's see. So yeah, so Dilshat is asking about the Miami housing market. We can't really give you much info on that here, being in Southern California. You know, it's a destination for everywhere, right? I mean, it's not just Americans moving to Miami for primary homes or for, you know, investment properties. You got people from all over the world wanting to go to Miami, live in Miami, have a second home and investment in Miami. The last time Miami experienced a hardship or a collapse was because they were overbuilding the hell out of that place. I mean, there was a high-rise condo on, every couple hundred yards. And when it crashed, there was just an oversupply of them. I don't know. I haven't been following the market in South Florida that much to know exactly what's going on. I do know, the market is still appreciating there, record sales. I know some agents that sell in that market and things are still moving. I don't know what's happening with supply, but I just know it will always be a destination that people want to visit. They want to go to, so I don't know outside of that, right? I mean, you got to follow supply and demand, but I think at the moment, because it's one of the hot metro markets, people are looking to, to move from colder areas to warmer areas. Canadians want to move south, that all of that, it's probably going to continue to do well. Outside of that, I don't have much info, but like I said, with everything, I got great people there if you need to talk to somebody. Were you snickering while I was on this?
Willing is now up to 17 titles. If you'd like me to go with 13 through 17, I can share them with you.
Well, let's right now we're
Flow like my
depreciating.
hair, mortgage and real estate. Win or lose, I'm still a wolf with Lewis. What I do isn't very nice, but I'm the best. And number 16 might be a personal favorite of mine. Rub my crystal balls with Lewis. And then the last one is make my day real estate.
Wow, we are really going down here, people, fast.
If you want to add those to the poll in case anyone wants to vote for one of those.
No, let's talk here. So Zachary also looks like a real estate agent. Kind of looks like Graham. Stefan too. I'm not sure what's going on here. Are we getting trolled? Any projection for SoCal REOs, so real estate owned? So that would be foreclosures. I would tell you that don't be holding your breath waiting for foreclosures to hit the market. But even if you do see some, which you're going to, and we have seen some come to the market, they're not going to be deals. We've talked about this, right? The market, too low a supply, too high of demand for anybody to price a home low and it come to market and somebody get a deal. If a home comes to the market less than what the market thinks it's worth, there's going to be so many offers on that property that it's likely going to end up selling for more than it probably should have, even if it was priced at fair market value in that case. So, there's not a lot of deals to be had. Now, the places to find deals in this market are off market stuff, right? People that might be in distress for one reason or another. Likely nobody's really, close to foreclosure because of a lack of equity at the moment, just because of where the markets have gone. But those are where you're going to find your deals. Outside of that, it's going to be tough. Anything coming to the market is going to get so much attention that, there's very little upside to be had on those properties, in my opinion.
So it's cause versus effect. People think that a property being a foreclosure or real estate owned is the cause of it selling at a discount. It's not. When there are a large proportion of foreclosures in the market, it's because there is a large supply of homes on the market. All homes are cheap. A standard seller will not sell below a certain threshold. A bank owning a property that they had to foreclose on wants the damn thing off their books, and the market will tell them what it takes to get it off their books. So people remembering, again, this is the problem of thinking 2008, 2009, 2010 was normal. It wasn't normal. We've had foreclosure markets before. You go back to the early 90s, we had a really good, from an investor's perspective, a really good foreclosure market where you could get nice discounts. 2008 was the greatest time ever. The first 5 homes I bought to flip in 2008 and 2009, there were no other offers. There were more homes, more foreclosure homes on the market than there were investors to buy them. So there was no one to bid against. So essentially, you were telling the bank, I will pay this, or you can have that sit on your books longer. So we are so millions of miles away from that. There's no such thing as a discount just because the bank owns the property. It is no different than any other home going into the market. And if it's desirable, there will be multiple offers, and the bank will pick the highest and best offer of those multiple offers to sell to.
No, good stuff. I've told this story before, but for those of you who don't know, like I sold a lot of foreclosures back in the day. I represented Fannie Mae, Wells Fargo, Bank of America on selling properties during the last debacle. And there was a time, like Josh mentioned, that there were deals to be had. We would do BPOs on properties based on whatever, and property would end up selling significantly below what we thought it would sell for, just because there was so much demand, or so much supply rather. But towards the end of it, even supply was even still high then, but the banks realized they didn't have to discount those properties. They could actually sell them at fair market value, and they did. And at that time, properties were still selling for and the foreclosures were still selling for what, a typical standard sell was going for at that time. So I think they wised up towards the end and realized they didn't have to give these things away. And, we'll see if that happens again, but it's not going to happen anytime soon. AB, do house prices usually drop in January? My area houses were selling 8 to 10% below list price across the board the past 3 weeks or so. I'm in a large metro area, so lots of data. So no, not typically. Usually, market, well, here's the thing. Seasonality wise, the market generally isn't a hot market in January. It doesn't start to pick up until February because normally December, the holidays kind of bleed over into January. People aren't really in the home buying mood as soon as the year starts, right? They're figuring out, okay, how do I have to pay for Christmas? I got to get my taxes filed. I've got to do all of these different things in order to kind of get myself in order. We've been in a crazy market though, right? A lack of inventory. And what happens is people are seeing rates go up. People are seeing a lack of options. So therefore, the market where I am has been moving full steam ahead. Now, if you're seeing a market depreciate, I'd love to know where you are, just because it's good information to have if truly that's what you're seeing. But no, I wouldn't say that's normal. I would say if anything else, it would just be slow, right? You wouldn't see a ton. The only time you should see big price reductions in properties is if you have an oversupply of homes in that market. And at the moment, I'm not really aware of many markets that have that, but I'm interested to hear location. So let me know.
Jeb, we got a fun question with an interesting answer.
All right.
Royal Scent. I don't know what a royal smells like, but Royal Scent says, do I have closing costs with the USDA loan? Absolutely. It's no different than any other loan. You're going to have escrow, title, title insurance, appraisal, credit report, all that fun stuff. The difference with a USDA loan, if you're fortunate enough to get an appraisal above your purchase price, you can borrow to the appraised value, the higher of the appraised value or the purchase price. So in a more normal market, it's not uncommon to have an appraisal come in $3,000, $5,000, $7,000 higher than the sales price, and you can borrow that amount and use it to finance your closing costs. The problem is you're not going to know about that till you're into a transaction, and you generally want to know that you have enough funds available to cover your closing costs before you actually enter contract. But it is a unique quirk of the USDA loan.
Let's see here. All right. Let's see what we got. So a couple people earlier were asking about companies like Fly Homes. Alex was asking about Fly Homes giving you a cash offer. Then you have another Alex Mendoza, saying any opinions like Ribbon Home to make cash offers. Market's tough for buyers. So I'm not truly informed on a lot of these companies out there. A lot of them aren't big players here in Southern California where I am. Because they only serve certain price points, and the price points where we are now are so ridiculous that they're not helping in those markets. But a lot of these companies, they work in one form or fashion as to, they'll give you the cash to buy a house with the expectation that you pay, certain fees, certain points on either the front side or the back side, or in some cases, both sides to do it. And in some cases, there's companies out there that want a portion of the profit on some of these houses, or will charge you a little bit more to buy the house back from them. So there's little nuances with all of these companies. Understand, if a company is buying a house on your behalf and giving you the cash to do it, there is going to be a cost associated with it. So it is never going to be as green, as perfect as you think it is going to be, right? I mean, the ideal situation is if you can buy it yourself and not have to have a third party buy it, because you're paying for it in some form or fashion. That's my thoughts on it. Wow. I don't know the intricacies of each one of these companies, but I don't think I need to, because again, anybody that's doing that in this market, it's a for-profit company, right? They're making money some way. They're not just doing it because they want to be the good guy like Josh and I, and do 2 hours every Wednesday with free live content and provide this. They're not us. They are not us. But if you're watching and you haven't hit the like button, you should, because we're nice guys.
So
anyway,
Jeb, not to plug another video, but sometime in the next 2 weeks on the Find My Way Home channel, we're actually doing an interview with
I don't believe you, bro.
With
I don't believe you.
With the head of Ribbon, explaining what their process is. Everything Jeb said is correct. These are not charities. They're not nonprofits. They are there to make money, just like people, hedge funds, corporations are buying whole tracts of homes to rent out because they have funds and they want to get a yield on them. So no one's just going to buy the house cash and then sell it to you for the same amount. There's a fee and a price for that, and the more risk and the longer they hold the home, the greater that is. But I'll have some more details here shortly.
Oh, Willing is still going strong over there. I'm just going to mention the last one because he's still looking for Ashley Wolf in the thing. So he's there. We got Patrick with real estate literacy. I like it, but if I had to say literacy that many times, I don't know that I could say it right. It would get botched every time I say it. Although I think it's good. Let's see.
J&J might have a bad connotation though in the current COVID environment. I don't know if we can go with J&J.
Okay, exactly.
I'm not taking the jab.
I'm not doing that. Let's see.
So let me, Jeb, just let me throw this one up here because I can't say this strongly enough. Chris Shine, I'm going to sell my house, take the profits and rent, wait for the next 2008 on steroids, then buy again. So you're never going to get another 2008. So a 2008 on steroids is a 12-year-old's wild dream. I can't tell you any more strongly than that. We will get a correction. Corrections are natural and normal. That was the mother of all real estate meltdowns and is never going to happen again, much less happen on steroids. So if you buy and rent, think about this. If the market moderates and we get 3 years of 4% increases, that's an additional 15% appreciation, then drops 20%, which would be a really big drop. You bought 5% cheaper than today, but you would have lost 3 years of home ownership, 3 years of principal reduction, 3 years of joy, waiting around, biting your nails, wondering when the mother of all meltdowns on steroids is coming. We will see a correction, but it's not soon, and it's going to look nothing like 2008.
There you go. Martina says, have a nice house, but not in the neighborhood of my choice. Is it wise to sell and buy at the same time, given supply is so low? Should I consider working with one realtor to help me with both? So tough question, right? Because at the moment, I don't know where you're located, but typically there's less available supply out there. So, selling your home and buying one at the same time is ideal. That's what you would like to do in the perfect world. And selling contingent is probably an option for you. It's difficult, right? Because there's not a lot of options to choose from. So it could be difficult to find the right one. But in theory, what you're trying to do, if people are saying this is a top, you're selling at the top, buying at the top, right? No real change. If you were to sell, you would have to rent something. And I don't think that's the best idea. So I think selling and buying something is great if you can find the right property. Just that's what you got to figure out. Talking to an agent, figuring out if there's anything out there in the market, figuring out how your market's responding to contingent offers. In this market, people are more willing to buy a home contingent upon the seller finding a replacement property just because they want to lock something in. They want to lock in a price and move forward. But if what you're looking to purchase isn't realistic, it's going to be a difficult sell from the realtor side. And while it does probably sound self-serving to say, yeah, you should use the same realtor for both, because you're selling your house and buying something else, and there's going to be contingencies and, multiple things happening, multiple legs of a transaction happening. It's beneficial to have the same agent doing both because they're going to be able to know exactly what's going on and be able to navigate it versus, the person helping you buy doesn't really know what's going on the sales side and vice versa, right? You need two people or one person rather working together on both to make the deal probably come to happen in a market where things are difficult. It's competitive. But what you're trying to accomplish, I don't think is unrealistic. Just you got to be patient. Don't sacrifice.
Jeb, just a little follow up on that. So yep. I get this a lot because I'm talking to people, past clients. They'll call, hey, can we afford? We want to do this. Okay, well, if I use the realtor that helped me to buy this house in Anaheim to buy my new house in Corona, they'll give me a discount. And that's probably not a good example because those two cities are only about 8-10 miles apart. But let's say that the two cities are 20 miles apart. I always talk to people that like, Jeb, you are a great realtor. But if we say, Jeb, go sell a house in Bakersfield, the technical aspect of selling it, you're going to be wonderful at, but you don't know that market.
Right.
What distance is reasonable to use an agent for both legs of that? And when do you start thinking, hey, I need an expert on both of my neighborhoods?
It's a difficult question to answer, right? Some areas are a little bit different, right? Like for me, I'm in Orange County. I could pretty much say I serve all of Orange County, but there are parts of Orange County that I probably wouldn't serve just because it's so far. Like San Clemente, I don't know that I would be your best fit just because it's so far south, right? While I know the area, it's so far of a drive for me that I just don't want to take that on. But the expert thing, right? So I had somebody reach out to me the other day and they said, "Hey, we're looking to buy in Huntington Beach and we're in LA and we're having an agent up here help us now. And we're, she's sending us property in Huntington Beach." And I go, "Where's she located?" And it was like somewhere in the valley. I go, "Here's the deal. Like, whether you use me or you use somebody else, you need to use a local Huntington Beach agent. You can't use somebody from LA to try to find something in Huntington at the moment, just because, for one, you need to know the market, know what things are doing, but it's also relationships, knowing about property before it comes up, having the ability to potentially know the agent on the other side in order to try to get your offer in first position, if that's even possible in this environment. There's just so many nuances. So you need to use somebody that's local, expert in the market. Can somebody travel 20 miles, 30 miles? Yeah, sure. But quiz them on what they know about the market. And if they're willing to move as quickly as they might need to move in order to show you property on any given day, right? If they have to drive 30 miles and you want to see a property, every day for the next 5 days, are they going to be doing that? Are they willing to do that? Those things, those are what you need to ask.
Jeb, you said quizm, and my thought was, what does my nephew have to do with you hiring a realtor?
Quizm. That's what I'm going to start calling him. Quizm. By the way, Sonny gave $50.
Sonny coming strong.
Sonny, I am currently enjoying dry January, so no alcohol for me at the moment. 5 days left. I think I'm going strong.
Jeb's never made a full January in his life.
Oh, no, I have. On my 40th, I made it.
He's been trying this and has never made it once.
Not true. On my 40th year, I made it until almost mid-March.
The 28th, till the 28th of January, maybe.
No.
Max.
Last year I failed. The year before I made it like almost 70 days. So I'm going strong. But thank you, Sonny. Sonny is a client. Actually helped Sonny put it into a home here locally recently. So appreciate you, Sonny. Thanks for looking out. Let's see here.
Sonny is the archetype for what we would all like you guys to aspire to be.
There you go. Yes. Having a lot of Sonnies would be awesome. Here we go. Rick Carrington, can you put 3.5% down on a second home, or is that only for first-time home buyers? So there's two things going on there. I'll address the second part of it, and I'll let Josh talk about the first part. So is it only for first-time home buyers? No, that's a misconception. The 3.5% down can be for any buyer. First, to, use it as many times as you want, if you will, with regards to, but it has to be your primary home. It can't be purchased on an investment property. It can't be purchased on a true second home. Like when I say second home, one that you're only going to live in part-time, second home. So FHA in this case is what I assume you're talking about, can be used as many times as you want to use it. Now, when you say second home, I think now that I've said that out loud, we need clarification. Are you talking about buying a property that is only going to be resided in for vacation purposes type thing? Or are you talking about buying another property after living in a primary home? This new one is going to be where you reside full time. So does that make sense? So once you answer that, then I guess we can answer that question. And maybe I already answered it. If it's going to be one you reside in it permanently, like as your primary, then you can use 3.5% down again. If it's going to be a second home, like truly, then you're going to need more down, and Josh can talk about what that requires.
Yeah, if it's a vacation home, 3.5% down is FHA. FHA will not allow you to purchase a second home. It's only primary residence. So what are we looking at? VA doesn't allow anything other than primary residences, other than refinances. So you're looking at Fannie Freddie, and they require 10% down on a second home. And it brings us to an important point.
Yes.
Sort of picking up the torch of what the Trump administration wanted to do. Biden's crew said, "Hold my beer," and followed up here. Second homes, as of March 1st, you're going to be able to do 10% down on a second home, but you will pay a 4.125% hit for the honor of doing so. So, a long way of saying it's
So what
about a
does that
percent.
mean?
About 1.25% to 1.5% higher interest rate, because no one's going to pay 4% of their loan amount in loan level price adjustments. They're going to take a higher rate. So in general, we say every point is going to push your interest rate higher by 1/4%. But the further you get away from what the 0 point rate is, the more it costs. So 4 points is going to be at least 1.25%, probably closer to 1.5%. So the reality is, Fannie and Freddie second homes are going to be a 25% down. Even at 25%, they're adding a 2 point hit, which is about 0.5% in interest rate. So don't know why, but both of the last hardcore Republican administration and now the hardcore Democrat administration are trying to one up themselves about getting Fannie and Freddie out of the business of lending on second homes.
All right. JW Studios asking, better to sell in February or March in New England. So clearly don't know New England, but I know you guys get snow. I mean, if I had to guess, probably once the snow subsides a little bit. But you also, I mean, in this market, things are still selling. I mean, I know it because I'm following friends on different social media platforms that sell property in areas where it snows, and they're still selling property. So I would say, yeah, you know what the market's doing now. You don't know what the market's going to do in March. You know where rates are now. You don't know where the rates are going to be in March per se. You know what your competition looks like now. You don't know what it looks like in March. So with that in mind, just know that the further you go out away from now, the more things could change, which could affect your pricing. Could be good, could be bad. You just don't know. So you just kind of got to do what's right for you, right? I mean, I would think in your neck of the woods, so to speak, March is probably when things start to loosen up a little bit. But if it happens earlier, if the groundhog, when does the groundhog see a shadow? When is that, Josh? Mid-February? I have no idea.
Later than that, I
If
don't know, man.
if
I live in Huntington Beach.
hold
We don't
on,
have groundhogs
the
or
question is
snow.
what's that groundhog's name? It's like something plucks
Punxsutawney Phil.
there it is. Yes. If he sees his shadow, you should sell immediately. If he doesn't, you wait. How's that? That's like a golden rule. I think that should be the new one every
At
year.
what point, Jeb, though, do you get in the bathtub with the toaster?
Every day.
Okay, so
It plugged in,
was
right?
that was my favorite part of Groundhog Day, was when
Yes,
he just
plugged
said,
in.
"I've had enough. I'm jumping in the old bathtub with the toaster." Actually, you know what? When he let Punxsutawney Phil drive them off the cliff into the gravel pit, that was my favorite part.
Here here we are. 277 people watching. We got 184. Like, you guys don't want me to get to 200. You're like holding out. I know you are. 16 people. That's all we need. Just push the button. There's nothing magical that
How
happens.
many kids do you have, Jeb? Your wife wanted 16, right? Can't you get all of your kids on there?
Oh boy,
To
if I had 16 kids, you would not see me ever again. Let's see. Is it viable? Ice tea. Isaac 1. Is it still viable to even bother putting 10% down on a condo townhome in the OC? My wife and I are looking to find a 2-bedroom, 1-bath home, or should we give up and look for a 1-bedroom? Can you put 10% down? 1,000%. Absolutely. You know, multiple properties last year closed with 10% down. So yes, you can find somebody to accept it with 10% down. 2 bedrooms, 1 bath. Here's the deal. The 1 bedroom, the lower bedroom bathroom counts you get, the less competition you're going to have, right? Because there's just less people that want, studios, 1 bedroom, 1 bath. I mean, typically speaking, most people are looking for at least a 2-2 in my experience. Now, here's what I'll say. Because of that, when you go to resell it, the properties that are 1 bedroom, 1 bath, 2 bed are going to be less desirable for the general population, right? There's always going to be less people, in my opinion, looking for those types of properties just based on experience. So you got to keep that in mind. I tell people all the time, don't sacrifice on the things that are important. So if a 2-1 is important to you, do not buy a 1-1. You'll regret it. Even if it gets you in the market, it's just one of those things. Now, if you're thinking, well, I was thinking 1-1, but I'd ideally like to have a 2-1, that's a different scenario. Maybe you consider the 1-1 too. But to answer your question, yes, you could still get away with 10% down. Just a matter of, price point that you're looking in. That's the most important piece of the puzzle is the price. And if you need help, reach out. Happy to help. Let's see. What do we got here, Josh? We're at 205, bro. I can quit. Show's over. That was my goal. Next week I'm going for 300 people. 300. I'm going up 50%.
You're easy. You're
50%
easy, bro.
next week. I like it. Let's see. February 2nd is Groundhog Day, so you better wait till March because I think that's too early. What do we got? Anything that you see that you want to click on?
I can't find it, and it's a simple one. So unfortunately, we're not going to be able to put you on the screen. But someone wanted to understand how lender credits work. So this one's actually simple when you grasp it this way. A lender on any given day has a yield they want on the money that they're going to loan, and that's known as the par rate. So let's say today it's 3.75%. They say at 3.75%, I'm not going to charge you any points, and I'm not going to give you any lender credit. So you might say, well, I want a lower monthly payment. And they go, cool, pay me money up front. So basically you're going to prepay interest, and then you're going to have a lower payment every month. On the other direction, you might say, I don't have enough money for my closing costs. Will you give me a credit? They say, yes. We're going to give you a higher interest rate, and we're going to give you some money up front. We talked earlier that the rule of thumb is for every 1/4% you go up, you're going to get a 1 point lender credit, 1.1% of your loan amount. So if you're borrowing $400,000 and the rate's 3.75 at par, meaning no points to be paid, no lender credit to be received on any given day, if you take 4%, they're going to give you 1% of the loan, or about $4,000 for your lender credits. If you say, hey, I have absolutely no money, I got to go higher, at 4 1/4, they're going to give you about 2% or $8,000 of a lender credit. And it works just in the exact same way in the opposite direction. If you go, oh, I don't qualify at 3.75, I have to buy it down to 3.5. Well, you pay 1% of the loan amount, or $4,000. And that's not a perfect relationship, but it's a pretty darn accurate rule of thumb. And you have to look at the rate sheet on any given day. We had Sonny pop in here and give us the $50 super chat. We locked a loan for Sonny this week. And for when we say that normally the rule of thumb is you pay 1 point, you get a 1/4% lower rate. Well, Sonny in that situation had the ability to pay 0.625%, so a little more than 0.5%, and lower it 0.375% in interest rate. So when you see inefficiencies like that, and it takes your break even from 4 to 5 years down to about 2 years, we took advantage of that. But that's how it works. You're going to pay a higher interest rate, which means a slightly lower monthly payment, and then you're going to get a credit from the lender to cover your closing costs.
Yeah, I think you just made that question up because I went all the way to the top and I didn't see anything about it.
Bro,
so I think you just wanted to talk about it to talk about
it. Just because you don't know how to search, I can't help you.
There should be a search box in here, really, because I think it would be easier. But anyhow,
the best part, Jeb, is Scott's trying to get into my prison cell right now, but he's stuck in the hall because come on in, Scott.
Scott, are you bunking up tonight? Double bunk, one bed?
We are bunking up. We have a lovely suite here at the what is this place called, Scott?
Contessa?
The Hotel Contessa in San Antonio.
I know there's only one bed in that room.
Yeah.
So Robert says, thinking of podcast name ideas: buy diligence, to buy or not to buy, strategy in realty, the fiduciary duty. I like the fiduciary duty, subjective value, duty of care. So we got some. Let's see.
I like fiduciary duty. I just think for most people, it's going to fly right over their heads and might apply to other industries.
Might apply to us too. It might fly right over our heads. We might not even be able to do it.
Robert's going to explain it to us when we name the podcast that.
All right. What are we pushing here? We're hour 55 coming in strong. A couple more
Jeb
questions
really
here.
wants out of here. He got his 200 likes. He's like, hey, you
I'm
guys
out.
gave me what I
211.
want. I'm
Nope,
done.
nope.
I'm done.
No, Dill
Now
Shat.
you know what it's like to date Jeb.
No comment. No, I'm just kidding. Can you talk more about different types of cash out? So you go to get cash out of your property, right? How does that work, Josh? And what are the options you have for cash out?
So really, every loan program has that option: VA, FHA. I'm not a super USDA expert, so don't quote me. I'm not sure you can do a USDA cash out, but Fannie, Freddie, FHA, VA, you can absolutely do a cash out loan. And it's as simple as, do I qualify and do I have the equity to meet their loan to value guidelines? So that's really all we're looking at. And all of them are going to charge a slightly higher interest rate for taking cash out of your home than for buying or doing a rate and term refinance.
There you go. Dude, Willing is still going strong.
Is he on 37,
He's on
38, and
55.
39 now? 55?
55. I mean, I feel like we're obligated to use at least one of them based on the time that was put into this. I don't know that they've stopped typing the entire time.
I want to know what illicit substances he takes at the beginning of the show to keep going full out for 2 hours every week.
Yeah, that's a good question. Let's see here. Question: what do you think about buying REIT stocks versus buying physical properties? Josh, you have any opinions on that?
I don't. I wish I did. I like properties. I like things that I control. Um, the good thing about a REIT is they're way more liquid. So if you don't like it at any point, you can get the hell out. A house, you have a house, a duplex, a condo, a apartment building. You have way more control over what you want to do with it. But a REIT is super liquid. You can get your butt out if you want, if the market turns.
Yeah, I mean, the downside would be if both appreciate. Why one you get capital gains exemption on. Typically speaking, if it's your primary home versus a REIT, you're going to pay capital gains taxes when you sell that thing. So, if both were to appreciate the same, you were to make the same amount of money off of them. One, you're going to pay a hell of a lot more in taxes versus the physical property. In which case it's an investment. You can roll it over and do other things depending on how you own that REIT or where you own it. You're not able to do that, right? There's tax consequences associated with it. So, again, not a super expert on REITs, but I prefer equities, stocks myself, if I'm going that way. But that's a whole different conversation. Yeah, Keith just said REIT stocks don't give you a tax advantage. Talk to a CPA. So that's good. So one last one, we'll end with Nadine here. Looking to buy our first home. Would you buy this winter, spring, or wait until later this year? We would do a conventional 20% down loan. So I would tell you, if you can find the property now, I would advise buying it now. You get to get away from renting sooner, get to start putting money into paying down your principal, which is a forced savings account. There are benefits to owning that. You get your mortgage deduction, your property taxes, all of that potentially to write off. And you get the appreciation that's likely to happen this year if you're able to find something. Now, if you're forcing yourself to find something, maybe it's not the right time. You wait until there's more options. But that's the simple answer. Josh, you want to add anything to that, or
No,
any outgoing advice?
No, I do. I think because of Sunny's super chat, we jumped past another regular viewer, BookTube Goddess, had a little story here. So, a fun update on my house journey. Decided to go forward, but then the title company wouldn't let us close. They couldn't find the deed. Then they found a 20-year-old mortgage by a mortgage company that no longer exists. Title wouldn't hold back double the mortgage, double the money of the mortgage, which was probably paid off. So now we're switching title companies and closing keeps getting extended. So these are fun things that happen. There aren't a whole lot of real actual title insurers. There are lots of title companies, but there are a handful of title underwriters.
Yep.
And a lot of the smaller title companies, your realtor or lender may like working with one of these smaller title companies. But when the shit hits the fan and there's something weird in the chain of title 20 years ago, they might not want to write over it or take the risk for that. So I would bet that you are now switching to one of the big title companies, Chicago Title, First
Yeah.
American.
Well, not even Chicago's not even the title
Chicago
company. It's
doesn't
like
underwrite?
no, it's like Fidelity or First. Like I
Fidelity or
think it's
First American?
Fidelity owns Chicago, Ticor, like 4 or 5 of those guys. And then you got First American. But yeah, anyway.
And I guess the bigger discussion there, Jeb, is like it's great. Title, we've talked about title insurance never pays off. I've known of 2 title claims in like 26 years in this business. Very rare that title insurance pays off. So your realtor, your mortgage person is probably saying, "Hey, I love this title rep who comes out, takes me to lunch, pats me on the back, is a good guy. Or I like the rate sheet here. Their rates are really good." Which is great until something goes sideways. So it's not a problem because it rarely happens. But in a situation like this, hopefully they at least have a relationship with one of the big title insurers and can slide it over. This isn't a big red flag. It's good that you have one of the big title insurers that's willing to write over something in the chain of title that the smaller title company is not comfortable with.
There you go. So I threw Josh and I's contact information up on top. If you want to reach out to either of us, there's a link in the little scroll there at the bottom. Get connected to a mortgage expert, real estate professional anywhere in the country. People that we know, like, and trust. As I mentioned, this isn't like a system that we're just referring you to random people. These are all people that, we know on a first name basis, have a relationship with, so can connect you there. So if you want to get connected, hit that. There's also an actual clickable link in the description below. You can do that. Josh, I would ask that you hit the subscribe button, hit the like button if you found any value, want to stay updated on this sort of thing.
Bro, how many do you want?
What's that?
You got 200.
I want 300 now. 215 is not enough.
Okay.
I want more. I want it now.
Greedy.
I don't want it. Yes, I do. I want it. I want more.
There's so many things
I tried to convince myself I didn't want it, but I do.
Wouldn't be family appropriate, so I'll leave them. I'll keep them.
So guys, thank you. We appreciate you. Thanks for those who contributed to the poll. We had 125 votes. The educated home buyer was the one that was was chosen. So
and they want that spelling, Jeb. They want that spelling of the.
I know BI, like buyer.
Yeah.
That gets weird. But anyhow, fluid. Thank you guys. Appreciate you. We will talk soon. Be back Wednesday. Until then, adios.
See you, kids.